what do the ideal teams of the future look like? If we happen upon a big market opportunity, fund a company that starts to do really well, an incumbent could launch a competitive product in less than 6 months. But at the same time, Cursor got to a 10 billion market cap with 60 employees.
22 unicorns, including 10 Decacorns and 2 Centicorns. Meet Ullas Naik, founder of Streamlined Ventures, a former equity analyst who covered the birth of the internet. Ullas launched Streamlined Ventures 14 years ago as a solo GP, still investing at the Series seed level and choosing to stay a solo GP in order to invest boldly with speed and conviction.
I've invested in over 600 companies now. 22 of them are over $1 billion, 4 across the 10 billion mark, 2 crossed 100 billion. My ambition is grander, but the expectations are also larger.
Well, congratulations on so successfully building up Streamlined Ventures. I'm delighted to have you on this show and talking to you today. So for those founders who may not know Streamlined Ventures, give us the 30-second.
All right. Well, Streamlined Ventures was founded 14 years back. We lead seed rounds. It's set up as a solo GP structure. Our average check is between 2 and 3 million. We've seeded about 180 companies now over the last 14 years. Roughly, I think now 22 of them are over $1 billion, 4 across the 10 billion mark, 2 have...
Let me pause there. Wait, 22 over $1 billion in 14 years. Amazing story. Keep going.
Thank you. So 4 of those went over 10 billion and 2 crossed 100 billion. So
you crossed 100, 4 over 10 and 22 over total over $1 billion. You must be, you need to be on the cover of the Forbes list.
No, far from that. Far from that, I'm not interested anyway. So I like to stay below the radar as much as possible.
Yeah, and that's why I'm so keen to talk to you. So before you started Streamlined, you have a very, very compelling personal story. I'd love to hear a little bit more. Born in India, came to the US, and a top equity analyst covering the internet, which is a little bit like what's going on today, right? This is the start of the internet, and you're on TV talking about the internet, educating mainstream. How did you get there?
A lucky break, I'd say. There's a combination of things. There's an awareness of something brewing, and it just so happened that I started talking about it first, or one of the first guys, and so therefore some success accrued from there. The way it came about is in 1993, I joined an equities firm called First Albany, and I was a software analyst. So actually, there was a junior guy reporting to a software analyst, and then eventually became a software analyst, and then. The internet thing was starting to brew on the sidelines. And I had this feeling in my bones that something bigger would emerge from it. At the time, it was AOL and Prodigy mostly, and then mostly command line interface, no web interface. But we were starting to see some indications of people working on trying to bring a more compelling user interface to the mix. And so I thought with the user interface truly developed, then everybody could interface and interact with each other. So I thought, okay, this is a good thing to be promoting and telling founders to go, build things. And I was fortunate enough that I started doing that in 1990, end of 93. And in 94, I started covering some of the stocks that were early in the mix during that time. In 1995, Mosaic/Netscape came along, and then the true interactive internet was born at that point in time. And so my timing happened to be good. I also, because I was early, there was no internet analysts that were really talking about it much. So every time CNBC would need an analyst, they would call me up and I would talk about it. And so founders found me through that process. Founders were starting new companies. And I started investing in their companies. So whatever money I wasn't sending back home, because we grew up relatively without means. And so I was angel investing before the term angel investing actually existed. And again, completely, good fortune. It was the first bubble was brewing. I had no idea. So I'd invested in, I think, 16 companies, and 5 to 7 of them became billion-dollar companies within 2 or 3 years because it was the first bubble. Not because of any true fundamental value, but just a bubble. I think at that point...
You can be an astute investor in a bubble.
And you can. What was interesting to me is that it was a frontline education on value creation. And it became very clear to me that value accrues to the value creators. And the value creators in my mind were people who built companies, the founders, and the people who supported them. So investors. And so that's kind of sort of what got me into investing as an institutional investor. So in 99, I teamed up with some people and helped build a firm.
Yeah, this is Jafco and just
Jafco at the time,
which later became Globespan.
We built that to about $1 billion under management over the course of about 13 or 14 years.
There's a lot there to unpack. Okay, so you're sort of covering not the plumbing of the internet, but you're really the interface of the internet today we take for granted. So you're sort of seeing the very birth of an application interface, which then was the web interface.
Yes.
Right. Subsequently, you've become a very successful applications investor. We'll dig into that a little bit more. But Globespan, if I remember correctly, and I was entering venture at that time also, if I remember correctly, they were an infrastructure investor. They were Series B, Series C, a lot of plumbing investments, networking investments. Yeah. So you had a front row to sort of the plumbing, the infrastructure layer, many successful investments. Name a few?
Yeah, we definitely had a front row there, front row seat in the plumbing side of things. Early optical companies such as Avanex was one, became a very large acquisition. We were also early in Palo Alto Networks, different kind of infra, but that came later. There were a number of networking companies and telecom equipment companies that we also invested in. Those are names from the past. Most of them were acquired. And if you remember the build out that happened in the late 90s, there were a lot of telecom equipment companies that were birthed for a reason, because the entire internet was being built. The railway lines were being put in place for this massive railway to be. The fundament of the internet was sort of starting to get laid, and so a lot of companies were born.
A lot of venture firms were born investing in that infrastructure.
A bit of a flash in the pan. It originated for that purpose. Raised $1 billion fund during the bubble. And then eventually disappeared because,
And then, come 2006, no one wants to touch plumbing, right? Or 2008, oh my God, we're running away from comms, right? And I'm bringing that up because, there's just so many parallels to this current moment. We're going to come back to that. But it is eerie in many ways as to the plumbing that's getting built, the capital that's coming in, and what's to come. All right. So Globespan, and this is where the story for me gets very, very interesting. So now you're a top equity analyst. You've seen the birth and covered the birth of the application interface of the internet that today is a multi-trillion-dollar market. In the 90s, no one anticipated it. No one knew it. This was a niche little thing, this tech market, right? It's more than mainstream today. We are in the world of the 7 MAGA. Then you have a very successful run at Globespan. It's $1 billion raised, a lot of, I'm sure, successes, learnings, a huge amount of experience there. In 2011, you start Streamlined. You're going it alone, and you are starting solo. You're not doing the Sandhill corner office. You're doing the coffee shop startup. Just how did that happen?
The way it happened was, at Globespan, we were a partnership. We grew to about 7 investing partners, and it got complicated. Where there was interpersonal dynamics that were challenging, and one had to navigate that. There was a lot of politics at play when it came to deal attribution, and then you scratch my back, I scratch your back. By the way, that's not uncommon. It's not something that happened only at Globespan. It happens to all venture firms.
I have a thought there because I too, learned the business that way in a partnership. And my early observation was that when you're in a firm, as you said, in many partnerships, I'm spending more time internally than externally. Right. That's so much time is spent managing partnership dynamics. It gets in the way of the business.
It does. It does indeed. And it's also not the fun part of the business. The fun part of the business is, in working with founders and supporting them in building really significant companies. And that's a complicated enough job in and of itself.
I think it also has an impact on the risks you can take. We're in the risk business. If you're in the right partnership, it can speed you up. You can take more risks. If you're not in that environment, it's gotten too complicated. I think the the bets tend to average to the safe and the median.
That is.
Would you agree?
I would agree wholeheartedly. I brought a lot of very exciting companies to the table that we were not able to invest in. And again, not just me. Same thing applied to other partners of the firm, where they had a fundamental point of view on it and conviction on it. But again, the decision making devolved to the mean. And so many really high quality investments didn't make it through. And despite that, we had our fair share of really high quality investment. I mean, we were early investors in Palo Alto Networks, in Blade Logic, Roku, Redfin, Upwork, Verident, lots of really high quality companies. But we could have had 2 to 3 times more if individual partners were allowed to run with their convictions. But partnerships are not set up that way, and they're not set up that way for a reason, because the LPs who invest in those funds want the appropriate checks and balances. They want the right sort of intellectual debate and rigor to happen between the partners in order for a decision to be made. It makes sense for people who are newer to the business because they don't have the underpinning, the instincts, all that kind of stuff that is necessary to make high quality, risk mitigated decisions, even in risky assets. And so I understand where it comes from, but to your point, it does have its negative side effect as well, where many high quality investment opportunities do get missed. For whatever reason, people have a bias on, I remember there was a husband-wife team that eventually ended up being a very successful company that one of the partners brought to the table, and two of our partners had a very strong point of view on whether you back husband-wife teams. Nothing to do with the fundamentals of the business. It was purely about this is going to create problems in the future. And again, there's some truth to that, but it resulted in a big miss for us. That happens. Those kinds of things happen all the time at venture firms.
All right. So here you are. When did you start Streamlined? So 14 years. So that's 2011.
Yeah, 2011.
I'm guessing sort of this is a smaller fund, much smaller than the Globes Fund. I can see the reasons. You want to move at speed. You have high confidence in yourselves. You are trained. You're trained as an investor by now. But sort of, going that small, starting early, on your own, no brand. You're in the valley competing with very, very competitive, most competitive market, competing with every brand name. You're hustling for deals. I mean, that couldn't have been easy. So what gave you that? Early days, there's no DPI. The markups are slow to come. It took 11 years to get to the numbers that you have, right? Those early years are very hard. So what kept you going? What gave you that courage to keep going and not get defocused? You could have given up. You could have given up in year 3, year 4.
Yeah, I could have, but it's not the fundamental makeup of who I am. And then that I think comes from breakage in the earlier part of my life where, I had something to prove, and I had a sort of irrational hunger, which still exists in a different way, presents in a different way, but at the time presented in a much more raw way. And so I had to make my mark. And once you go down the path once the decision was made, there was no going back. It had to happen. The exact nature of how it happened could sort of evolve, but it had to happen. There's no escape from that. And some of it, as I said, some of it comes from that early breakage. Some of it comes from a sort of a comparative reckoning. Like you look at others and you think to yourself, I'm better and I can do it better, or I can do it more, or whatever it is. And I think some of those things are also an artifact of being younger.
Let's sort of shift gears a little bit. Let's shift to, so now you're making those investments, small investments. Let's go back to those 22 over $1 billion and the 2 over $100 billion. Okay, so now you probably have a very different perspective on those companies today. Now, this is all in hindsight, right? So, but that perspective is so important because that learning and that perspective is going to make you a better and stronger investor continuously as you make new investments looking forward, right? So let's talk about one. I can guess one of them is probably AppLovin. And
yeah,
I was just looking at their market cap today. So close to $200 billion in market cap, $5.7 billion in trailing 12 months revenue. but get this, 3.7 billion in EBITDA, still growing at 40%. It's a cash machine and it's still growing. I mean, that's an amazing investment. So walk us to that very first check, where did you meet them? Who did you meet? How did that come about?
I met Adam Farugi, the founder of the business. And I had the good fortune of having been part of investments in the ad network business at GlobeSpan. So we had invested in 3 ad networks, all successful. So there was familiarity with advertising networks, while the vast majority of Sandhill either didn't have familiarity or didn't have comfort. So people didn't like ad network businesses. But I had no problem with it because we had succeeded.
And what year was this?
This was 2010 or 2011, somewhere in there.
Yeah, 2011. I mean, ad networks are going out of favor. No one wants to touch that. Right.
That's exactly right. But I had the good fortune, luckily, that I had we had successfully invested in ad networks, so I wasn't daunted.
Quattro Wireless, I remember. Boston success story, right?
Well, there was that. There was Dotomi. There was Amobi. There was a variety of other companies that all did very well. Again, not daunted by advertising networks. Then I met Adam, the whole thesis was, look, this whole mobile thing is becoming big. There's going to be a massive migration of online ad inventory into mobile settings, and there's no intelligence network to drive it. It was an absolute no-brainer. The trend was accurate, was on point. I fundamentally believe that. But what was more compelling was Adam was an extraordinary founder.
I'm just curious, was this a gradually building the case, or was it one of those 10 minutes and I know in my stomach, I'm going to do it?
Probably a minute. Maybe 10 minutes, whatever. Point is, yes, it was very quick. My biggest...
What?
And why?
Yeah.
Because again, I had a prepared mind on the...
You had the prepared mind. You had the experience in ad networks.
Correct.
The prepared mind.
He was focused on the right transition in the market. So that was important. And then it was him and his sophistication and articulation of how he was going to build something meaningful. There was zero... Even in his mind, there was no conception this would be even a $10 billion company at the time. We thought we could build a $1 billion company. That was kind of the intent. I was like, that's doable here. I should be a part of this. And so we invested. I introduced it to a few other people around town who will owe me forever for having gotten them into that deal. And, to be honest, I mean, it became profitable very, very quickly. The company started throwing off cash from the early days. He wanted to go raise a Series A. I introduced him to probably 15 firms around town. Everybody passed.
And everybody passed because by now Facebook's killing it, and that's the model, and this sort of, what are you building? We don't buy it. I mean, just why did everybody kill it?
I think mobile was still relatively early. Facebook certainly was a piece of it. I think Google was very dominant. And I just don't think people are that excited. They always, the general belief in ad networks is they're generally low margin businesses and they take a long time to scale. Whereas they didn't spend the time to understand why what he was doing was so different. And the reason it was different is it was a fundamental, deep analytics company. The team he had put together, the technical team he had put together around the analytics needed to get CPMs higher. There was a structural difference in terms of how ad networks were built before and then what Adam was doing. That was what was most exciting to me. And actually that's kind of sort of held up over time. You just mentioned the statistics about how profitable they are. That all started from day one based on his fundamental premise that I can target significantly better because I can process a lot more data so I can then analyze and assess which is a better customer to show the ad to. And so that's why they're able to basically drive higher CPMs. And so...
And then he really catches fire in 2018 when he goes after buying data and the data to train his algorithms, and he decides he's going to start buying gaming companies. I mean, mobile gaming is not a hot thing then. Yeah.
No.
Right?
No.
So very astute move.
It was an astute move in that he was going to focus on gaming as a vertical initially. And then maybe that would be the business. That would be the whole business, which is I can just identify really well. I can place ads inside of free gaming, and gaming drives a huge amount of traffic, and I can just build a profitable network doing that. What he realized over time was I can now do this across other verticals. Gaming is a start. We build the engine, we build the technology. I can now apply it to other things. And so that's when I think that's when it became clear to others that, wow, this thing is going to get much bigger than you originally thought.
So all this time, he did not raise a lot of capital. Sort of what was your interaction with Adam like? What was that journey together like for you as an investor in the company? Nothing was in a straight line. He was profitable, so he was in control of his own destiny. He didn't have to go back out and raise more capital.
To be honest, I think it's Adam is one of those founders where I wish all my founders were like that, where it was extremely low touch for me. I mean, Adam was doing everything. He was extraordinary in his thinking around execution. He had built a team of 6 direct reports that were, each of them could be a CEO of a company. And those direct reports ran the businesses, and Adam, they surfaced exceptions up to Adam, and he was so focused on all the strategic elements. He didn't need me. I was on the sidelines cheering as much as I could.
And you were a smart enough investor to know, not just more experienced enough investor to know when to come in and when to get out of the way, right?
Exactly right. And then others were the same way, which is everybody just saw that this thing had caught fire. Why would you ever get in the way of that? And let him, and he's doing a good job. He's doing a great job. Let him.
Amazing job. So just to put those AppLovin numbers in perspective, your going in price in 2014 and their $4 million seed round was $29 million post money. Today, the company is trading at $200 billion in enterprise value. The company never raised more money after your round, so your dilution would have been de minimis. But let's assume you suffered a 50% dilution from that entry point in 2014 up till today. Even with a 50% dilution, this would be a more than 3,500x return on that investment. Kudos to you. Congratulations. That is the power of early stage investing, and you knocked it out of the park. So let's pick another one maybe where it's more recent. Yeah, Silicon Valley is famous for groupthink, and where you're bucking the trend. Maybe others are not seeing it. You're doubling down. Do you have an example you can share?
There are many examples. I think we've been relatively early on some trends. I mean, I think now crypto is back in vogue, but quantum computing stocks are doing really well. We had invested in a company called Rigetti Computing, which now, if you look at the quantum computing wave, they're one of the 3 companies that have massive market caps. So Rigetti is now a $15 billion market cap company. But we had done the seed round in Rigetti, and that was a tricky journey. And this was when nobody was doing quantum computing. So this would have been 2013, 2014. Very early in the game, in the quantum computing game.
You wrote a check from a small fund, what must have been much smaller fund at that time, into a quantum computing company. I mean, that's a bold move.
Yeah, and I don't really do that much hardware. But again, it comes down to timing, market timing, feeling that something is starting to brew. I'd been looking at quantum computing for 15 years before. I just hadn't done anything in it because I just thought it was too early. And then I met with Chad Rigetti, and Chad was bringing fab technology from conventional fabs into the building of quantum computers. That was one piece of it. His software chops were incredible. He had put together a great brain trust in quantum computing. So I was just like, okay, there's the team element checks. The disruption element also checks. Market timing might still be a question. And to be honest, it's still a question even to this day. But it was an unconventional bet for sure. And it was a tough journey. It was a capital intense journey. And, we kind of sort of tried to keep up as much as we could, sort of put it into a couple of our opportunity funds and so forth. But that was definitely a very unconventional investment in 2014, I think. And fortunately, I mean, it's kind of worked out. It had some challenges. There was a recap financing and all that kind of stuff that we had to go through. But here's this company that's worth $15 billion.
Amazing success story. Let us just shift gears to the current climate here. All right. So these are very interesting times. I mean, this is so many parallels to the internet build out. What are you investing in? What do you see as the future? Is SaaS dead?
I think there are parallels to the old days, but it's different. The market opportunity is large, perhaps larger. The incumbents have significantly more power in this market. It's treacherous for startups. So, at OpenAI, if we happen upon a big market opportunity, fund a company that starts to do really well, an incumbent could launch a competitive product in less than 6 months, like a truly disruptive competitive product in less than 6 months. And in addition to that, they have the balance sheet strength. So they have financing advantage. They have the distribution advantage. They have talent advantage. So it is actually a much trickier time to be building for the future than it was during the early internet days. The early internet days was sort of a Cambrian explosion that happened. OpenAI and all these guys will have their own products. They already have them, but they'll be so compelling that they then eventually just bundle it and give it away. And if that happens, that will kill a lot of startups that develop just for that purpose. And so that kind of thing exists around video. That kind of thing exists around a variety of other vertical applications. I think it's a really tricky time. So what we end up investing in, therefore, is vertical applications. These days, everybody's talking about agents. Yes, so our companies are vertical agents. But vertical agents, you have to be also careful about that the verticals they don't have powerful incumbents in those verticals who can come in with relative speed. I still think you have defensibility in the various verticals, but we need to be a lot more vigilant than we probably had to do during the days of client server or even cloud/SaaS.
What about has it affected your thinking on portfolio strategy, capitalization? Are you building a bigger portfolio or expecting a higher loss rate? I mean, double click a little bit on what this is different means from an investor's point of view.
I think just as I mentioned that the incumbents have more power, the incumbents on the capital side also have more power. So what that means is if I were a larger fund, I would have a seed portfolio where I just sprinkle a lot of bets. I wait for signal to emerge, and then I double down on a few, and then put big dollars in there. If that's the winning model, then I actually have somewhat of a losing model in being just in seed, right? Because I don't double down as much, and there's a higher mortality in the seed. So I have to be super thoughtful and careful about making sure that my portfolio of, we do 35 companies per fund, that my portfolio of 35 companies has at least one or two that are going to break out big, and then probably 5 that'll be okay, and the rest can fail. That's probably what the makeup of success in this kind of an environment will look like.
Have you always done 35 companies, or this is sort of a more?
I've determined. My first couple of funds I did 50, and then I decided to concentrate more as we started to get the conviction level rose with more success. Right, that makes sense.
You're balancing ownership with sort of at bats, goals and shots on goals.
Yeah, exactly right.
Yeah.
And I may change that model all over again, where what I say is, look, only a few are going to win per year. And I want to make sure I increase the odds of being in those few. And it almost doesn't matter what side of the check I have, because if the few that win will win so big that'll make up for it. Maybe.
So hold that thought. So on that, pricing for these companies is through the roof. I mean, how do you think about pricing? Will you walk away? Will you walk away from a price?
That's the tricky part. Today's market's a tough market. It is a tricky market. In the last year, I have participated in market inflation. So I've invested in expensive rounds. I have, because the things that those founders are working on are so big that they can get away with raising at those valuations. And I can't get away by not being in them, because it's the same 100x math potential exists. But the thing is, if I was not in those, the 100x math potential does not exist in the cheaper ones. That's the challenge. So
That is the truth.
yeah. Anyway, the being in the cheaper ones, I mean, if you're lucky enough that you found the right founder with the right idea and you just got him or her at just the right time, sure, we'll get cheap ones, and we'll get a handful of those too. But I think the market catches on pretty quickly. Those smart founders are not price takers, not in this environment. At some point that may revert, but we're not there right now. So yeah,
Give us a few examples.
at any point in time. So I like, of course, the points.
So just double click on a couple of examples here that just, adds a bit more color. What are some of these investments? The ones you can talk about.
Yeah.
Stealth.
Well, most of the recent ones are expensive ones are still in stealth. But I'll tell you, I'll give you one because they have another round in progress. So I'll probably no, actually, let's hold off on names. Well, I'll give you the broad strokes on it.
Yeah, strokes.
Broad strokes. It's a company in the AI infra space. But it's a software infra that allows AI services on demand at high velocity certainly for existing cloud vendors, but more for the bare metal service providers. There's tons of them all over the world. And with this, they have an instant AI stack that they can sell to their customers. So we invested in that company, very compelling founder. Some relatively prominent people from the Valley came in with us. We invested in the seed round at a $45 million valuation. That was their pre-seed. They're raising a seed right now, 3 months later at 200, and they'll get it done easy because the play is big. The play is very big because the thought process is not just around sort of this AI on demand, but it's also around serverless and all that kind of stuff. So you can offer a whole host of services that eventually even existing scale-out clusters will be able to sort of leverage. So it's one of these plays that actually leverages this trend around lack of data center capacity, and not just capacity, but also intelligent services on top of the capacity. So it plays into that trend, which, I mean, if we can see it, others can see it. And that's probably what's going to happen. And this is a company that, we seeded 3 months back, or pre-seeded 3 months back, and it is quite likely it may go public by 2027. So in a year and a half. And who knows what valuation, and markets may change and all that stuff. But right now, that's the current.
It's absolutely on trend. It's absolutely on the data center or lack of data center capacity trend. So fantastic. And how do you think about building? Now, this one is more of an infra company, so they're building a real software stack. There's sort of deep development here. But what about application layer? I mean, we don't need software engineers apparently anymore. And so how do you think about that? How will these new application layer companies get capitalized? How are you thinking about them? What does that pre-seed seed round look like in 2-3 years from now?
Yeah, it's interesting. I've been talking a lot to our founders about this. We had a founder offsite last week, actually, where this was one of the topics of conversation, which is that what do the ideal teams of the future look like? And the discussion was around, you need 2 front-end developers. You need probably a bench of up to between 5 and 10 back-end developers on an application, because everything else will be tooling. And then you need just go-to-market. So the teams of the future are going to be smaller to get to a certain critical mass. And then eventually you probably, especially if it's like SMB or enterprise sales, you probably have to have bigger GTM teams. But the actual underlying technical teams may not be as big. I do think that's the current thinking, but I don't know if that holds over time, because code bases change and you got to evolve the code base and all that kind of stuff. So all that requires a set of skills to do that, but maybe tooling emerges for that as well. Whereas next generation of code or of technologies like a .NET or something like that emerges, you'll just have tooling that naturally keeps existing code bases up to spec with the next generation of of the underlying infrastructure or Java code or whatever it is. Don't know. So we'll have to see how that goes, but the teams most likely will be smaller, which means if you find the right kind of company, I mean, those should be more profitable. They should be more revenue per head, all that kind of stuff. I mean, the classic, we just talked about how code writing as a standalone value prop from companies like Cursor and all that may not survive if OpenAI and Anthropic had bundled them. But at the same time, Cursor got to a 10 billion market cap with 60 employees. And so I think that's what I recall. With 60 employees, they got to a 10 billion valuation.
10 billion valuation, but significant capital raised, right? So we don't know the capitalization question. I remember when when cloud was taking off, SaaS was birthing that entire, it takes so much less capital now to start a company, which is very true. But look at the ultimate capitalization of these companies, way, way, way higher, orders of magnitude higher than pre-cloud, pre-SaaS.
Those companies became much larger. So, if you did the apples to apples, if you said, how much does it take to build a $10 million revenue company? And then how much
to build a $200 billion, right? Yeah.
Fair enough. Same thing will apply here, which I think it'll be cheaper to start the companies because you just don't need that much upfront. But as you scale it, and depends on the tooling again. But if the tooling is compelling, then maybe you still need smaller teams. I do think there'll be smaller teams, but I just don't know how much smaller.
Right. And what other costs will emerge? Well, very exciting times. I can go on talking to you on many topics. You a wealth of depth and breadth of experience there that I can learn from. I have one last topic, sort of your role as an investor. You're a early stage investor. You're there right next to the founders on the cap table, more or less, right? And then these companies are over time some are raising no money, like AppLovin, some are raising hundreds of millions, right? So let me just start with, do you take board seats?
I do.
Are you always taking board seats or?
Not always.
Not always.
Yeah.
At what stage do you advise companies to form a board? Pre-seed, seed, A?
Not so much pre-seed, because pre-seed is invariably pre-product even. And so I don't think they need a board at that point in time. Occasionally at the seed stage, certainly at the A.
That's probably a good segue to my last question for you, which is, so I'm a founder, I'm raising my seed round, let's say not pre-seed. And I have 3 term sheets from mainstream Sand Hill Road firms. And I have a term sheet from Ullas at Streamlined. Why should I take Streamlined?
And there's different reasons to take different offers. So the traditional Sand Hill firms certainly have a brand name. And so there's value to that. But the people running those funds, so the seed fund at a large fund is run by 2 people. That means, let's call it's probably a $200 to $500 million vehicle. That means 2 people are deploying that much capital, which means you're not going to get any attention at all. So there is that risk. There's also the signaling risk, but I think that can be mitigated. But the signaling risk is if they don't come back in to lead your Series A, that says something. So why raise from me? 1, no signaling risk. 2, a person with, I've invested, my investment experience across the 3 venture firms and all my angel investing, I've invested in over 600 companies now. And so there's a lot of them have become very large. A lot of them have failed. So there's learning on both sides. So I think you get the benefit of having somebody like me on a direct dial. That has value. We can engage in some high velocity problem resolution, which you may not get at the middle manager who's running a seed fund at one of the larger platforms. I mean, that's just kind of what it is. And so, and partly because they may not have the experience. Not that nobody's a bad person, it's just they just don't know, right? Whereas I've just seen so much that at this point, the velocity with which we can resolve problems is higher. So I think that's another piece of it. The other is a sort of a more holistic approach, because again, having seen companies through the full life cycle over and over and over again, it shapes perspective. Probably my ambition is grander, but the expectations are also larger of the founders, which means that I'm probably a harder taskmaster, but not because there's an ego associated with it. It's more because having seen it before, that's the expectation.
You've seen the success, you know what they can achieve, and you're going to push them harder.
That's exactly right. So I think all that is a benefit to founders, and therefore if they want those benefits, then they should pick me over others.
I would absolutely pick you over others if I were starting my company. Okay, well, always amazing conversations with you. Wonderful to see you, and thank you for doing this.
Thank you for having me.
And I hope to have another conversation when you're on Fund 10.
Okay.
Or maybe before.
We'll do that.
Okay.
All right.
All right.